So we are starting with the most important chapter of international taxation, and that is transfer pricing. Before I could go forward and discuss the transfer pricing provision with you, one of my humble request, if you have not studied the provisions of GAR, General Anti-Avoidance Rule, then first please complete GAR provision and then only come to transfer pricing. Why? Because while discussing GAR provision with you, I have already given you the background of transfer pricing provision with a historical background. Why transfer pricing provision has emerged internationally and then why India has adopted transfer pricing provision here. Obviously here also I will give you one example to make you understand, but please finish your GAR first, then only come to the specific anti-avoidance rule at international level. The transfer pricing provisions are one of the provisions which are incorporated in income tax law based on specific anti-avoidance mechanism. Okay, sir, why do we need this transfer pricing provision and what is exactly transfer pricing? So for my understanding, I believe TP provision was supposed to be a separate act. It need not to be an income tax act. So government of India might have thought that instead of creating the new act and then there will be new legislative body, new department, we can emerge this particular provisions into income tax law. Now in income tax law, these provisions are spreaded from section 92 to section 92F precisely. They talk about transfer pricing provisions and procedural aspect, what should be done, what not should be done. Everything is covered in 90 to 92F. Please understand, this 92 to 92F may seems like a few sections, but in reality it is a separate legislation altogether. And because of this specific legislation or specific anti-avoidance rule, India was bleeding the tax revenues. Please understand, foreigners were literally killing India, the taxation system that has been reduced tremendously after the introduction of transfer pricing provisions in income tax law. Sir, what was exactly happening with India? So far as India is concerned, internationally we have discussed in GAR. Now let us take one hypothetical example for Indian entities. So this is an India, you know that there is one entity in India. There is one country, foreign country, we will name the foreign country, it can be any country, it can be Japan, it can be Canada, it can be USA. And a foreign country is dealing with India. Usually, if they do the transaction on arm's length base means the cost of the product in their country, the total cost, including whatever their profit margin, everything that they want is 10 lakh rupees. So they wanted to sell it at 10 lakh rupees. The selling price, usually this foreign country, used to transfer to India, usually at arm's length price, if they transfer and if they sell the product in India, should be 12 lakh rupees. Okay. So their profit in that country, genuine profit is equal to, please understand, genuine profit is equal to 2 lakh rupees. And now the Indian entity, the associate entity or your subsidiary company or your branch or your department, whatever you wanted to call, in international transfer pricing, we call them AE, associate enterprise. Okay. It can be holding company or subsidiary company. So you take an example of H company and subsidiary company. This subsidiary company is supposed to make sales in India for the same product at a rupees 20 lakh. So profit in India at arm's length price, genuinely if they do something, so 12 lakh rupees is their input cost and 20 lakh rupees is their output cost. Ignore for time being operating cost in India. Overall profit in India should have been 8 lakh rupees. This is a real transaction that I am telling you. In reality, this should have happened in this manner. The cost of the holding company should be 10 lakh rupees. The transfer price of this particular commodity to India should be 12 lakh rupees. And in India, the subsidiary company should have sold this product in domestic market for 20 lakh. So India should have booked the profit of 8 lakh and the foreign country should have booked the profit of 2 lakh. They should have paid tax on 2 lakh in the foreign country. This company, the subsidiary company, Indian subsidiary company should have paid tax on 8 lakh rupees in India. But later on they come up with an idea, a beautiful idea. Instead of transferring this product at 12 lakh rupees, let us transfer this product to India at 17 lakh rupees. So what will happen because of that? Because of this, the profit in the foreign country now is a 7 lakh, please understand, and profit in India has reduced. Profit in India has, selling price will not change, selling price will remain same, selling price is equal to 20 lakh only. Now the input price is 17 lakh, so profit in India has reduced successfully to 3 lakh. So what's wrong with this? If the country India is not booking profit, then foreign country is booking profit. Now you must understand, the foreign country's government might have given tax incentive on this foreign tax profit, or this country, this foreign country might be the tax haven country. So what do you mean by tax haven country? It might be the no tax jurisdiction or low tax jurisdiction. Please understand, tax haven is equal to no tax jurisdiction or low tax jurisdiction. Okay, so there are a lot of possibility. So this foreign company or holding company might not be paying any tax on this 7 lakh, and even if they are paying tax, the tax amount should be the low tax. And the third possibility, even if they are paying, assume that they are paying tax at the rate of 30% as compared to India, even if they are paying 30%, let me tell you one thing, paying tax to your country is always preferable than paying tax to the foreign country, isn't it? Therefore, in this whole transaction, by just changing the transfer price, please understand, just by changing the transfer price of a goods from holding company to subsidiary company, they have successfully evaded tax in India. And definitely now Indian government is worried about it. So in 2001, we have launched the anti-tax evasion mechanism on such transaction by introducing TP provisions. Now what government of India will do? Government of India will say, okay, the arm's length price, the genuine price, the fair market value of the transaction should have been 12 lakh rupees, but you have imported goods at 17 lakh rupees, meaning thereby you have increased your profit and loss account debit side to purchase. It was, you are showing it 17 lakh, but actual price is not 17 lakh, actual price is 12 lakh. So the gap of this, sir, how much is the gap? Gap of 5 lakh rupees will be added to your profit. Whatever net profit you have shown, say for example 50 lakh rupees net profit you have shown. Now in this 50 lakh rupees, this 5 lakh rupees will be added and the tax will be computed in India at 55 lakh. Meaning thereby any price, please understand, any price that you have paid, any price that you have paid or Indian entity have paid beyond the arm's length price, beyond the reasonable transaction, beyond the fair market value will be disallowed. Similar provisions we already have in section 48(2) of income tax law, but section 48(2) covers very specific transaction, my dear friend. It was not capable enough to handle the transfer pricing provision, international manipulation, because at international level the transaction will not be very simple transaction or one step transaction. Sometimes 8 entities, 10 entities, 12 countries, many countries are involved into the transaction. Obviously international player will take the consultancy from the global consultant, the expert, the big fours, and they will find the loopholes in domestic tax law and they will try to exploit that domestic tax law, the loophole. That should not happen, therefore transfer pricing provision was involved. Now sometime it may happen, not necessary, it may happen that actual transaction price, please understand, actual transaction price was 17 lakh. The arm's length price ALP that we have determined was 12 lakh. So there is an addition of 5 lakh rupees. So we have accepted it. But sometimes it may happen that actual price was 11 lakh. The arm's length price is 12 lakh. Now please understand, this negative 1 lakh, this negative 1 lakh will be ignored. So what are you trying to tell me? If due to application of transfer pricing, your profit is getting reduced, so that is a loss to the Indian government. Please understand, if we are applying the transfer pricing provision on you, we are applying anti-tax evasion provision on you, and your profit is getting reduced, then the whole purpose of the tax system will be defeated. There is no point in leaving the transfer pricing provision on you and wasting time on you, because after leaving the ALP, after bringing the ALP into picture, our profit is going down, or our loss is increasing. Please understand, these are the same thing. If my loss is increasing, then also there is a loss to the Indian government. If the profit is decreasing, then definitely there is a loss to the Indian government. Meaning thereby, if applying the adverse, please understand, if applying the arm's length price provision is creating adverse effect. What did I say? If applying arm's length price is creating adverse effect on the tax collection of government of India, they say transfer pricing provisions will not be applicable. So what are the primary sections then? The primary section that I have already given you introduction in your GAR provision, but let us discuss one more. Section 92 is the charging section. Charging section says there has to be international transaction, or let's say there has to be associate enterprise, that means related party, because we assume that the evasion will happen through related party, but definition of related party here is quite wider than what you see in domestic tax law. Then they must have done the transaction, and that transaction has to be international transaction. Please understand that transaction has to be international transaction, or very, very important, specified domestic transaction. It is also applicable to some of the specified domestic transaction. So what do you mean by specified domestic transaction? International transaction means transaction where either one of the parties is non-resident or both of the parties are non-resident. So you need to understand, my dear friend, there has to be associate enterprise, and those associate enterprise must have done the international transaction. Now we are going to learn what is, just giving you a hint of specified domestic transaction. You people have done section 10AA with us. You know that 10AA is a SAZE unit, special economic zone unit, which is having 100% tax exemption or deduction for first 5 years. Now what people will do, this is known as the eligible unit. People will have also non-eligible unit. They will try to book more profit in eligible unit and less profit in non-eligible unit by doing the transaction. And both of these units are located in India. Therefore, by just shifting the profit from the books of non-eligible unit to the eligible unit, they can easily manipulate in the tax revenue system. So the manipulation need not to happen only at an international level. Manipulation might happen at a domestic level. So we are having two types of transaction here. One is definitely international transaction and specified domestic transaction. Not all domestic transactions, specified. So there is a definition of specified domestic transaction that we will look into. Whenever this transaction happens, transaction between associate enterprise and it is the international or specified domestic transaction, it has to happen at arm's length price. So these are the three main words given by section 92. Then section 92A talks about what is associate enterprise. Section 92B talks about what is international transaction. Section 92BA talks about, please understand, section 92BA talks about what is specified domestic transaction, and section 92C talks about, so what do you mean by arm's length price, or 6 methods of, there are 6 methods of computing arm's length price. We have to learn those 6 methods of computing ALP, fair market value. Whenever you do, obviously you are doing at international level, government have to keep close watch on you. So they say you have to maintain lot of documents. Okay, lot of document. D stands for document, C stands for computation, B stands for business, that is international transaction or specific domestic transaction, A stands for associate enterprise. So this is kind of ABCD of international taxation. Okay, now documents will be maintained. Whenever documents are maintained, we may rely on documents or we may not rely on the document. Therefore, the cross check has to happen from the professionals in India, and the notified professional as of now is chartered accountants, practicing chartered accountant. So in 92E, they have to issue the certificate. Please understand, transfer pricing certificate or CA report. We say CA report. Transfer pricing report, TP report will be issued by one chartered accountant certifying that yes, whatever compliances are supposed to be done has been done. Okay. So look at the detailed summary section 92. The name of the section is applicability of transfer pricing, charging section you can say. 92A associate enterprise, 92B international transaction, 92BA specified domestic transaction, 92C read with rule 10B arm's length price computation of ALP. So what is there in rule 10B? The method, 6 methods of computing arm's length price. 92CA transfer pricing officer. Obviously, we need to have the expert officer who will understand the international market, how the policies work. So we are having AO, and AO may not be able or may not be capable to handle the transfer pricing provisions. So AO may take help of TPO. AO may refer the case to transfer pricing officer. Power of board to make safe harbor rule. Safe harbor rule means kind of presumptive rules that we are having in India, or you can say the exemption methods through which people can enter into India and they will not be questioned for their transaction. So it is a minimum margin. So safe harbor rules means minimum margin. Say for example, in one particular business, in the business of computer software, the margin is notified 17%. So if you declare any profit more than 17%, then we will not question your arm's length price. So safe harbor rules means minimum profit margins declared by the government. If you declare more than that margins, good, no transfer pricing compliance will be imposed on you. But if you declare less than that particular profit margin, then we have to cross check your transaction values. 92 CC advanced pricing agreement. We say prevention is better than cure. Once you've done the transaction and then there will be dispute between government of India and your entity, and then lot of issues may happen, lot of penalties may be imposed. So the better and the best option is before entering into India, you should sign the advanced pricing agreement, meaning thereby you should determine your ALP. You will discuss that ALP and your project with government of India. Government of India will certify the project. Okay, this is the ALP for you. And if you do the transaction based on the documents provided by you, then there won't be any questioning in the future period. So advanced pricing agreement means before entering into transaction, you are consulting with government of India. Is this a right price or not? Okay, so you are taking the in principle approval. So this is APA, very important provision for reducing the litigation which are there in transfer pricing. 92 CD, effect of advanced pricing agreement, connected section. 92 CE, there are two adjustments that we usually do, primary adjustment and secondary adjustment. The concept of secondary adjustment is recently amended by Finance Act 2020. Therefore, mark it as one of the most important. It is highly expected in exam that there will be question on section 92 CE, secondary adjustment, because government have changed the rules. 92D, read with DA, talk about documentation, and then 92E talks about CA report. 92F talk about definitions, definition of particular terms which are used in transfer pricing. 93 avoidance of income tax by transaction resulting in transfer of income to NR. So separate point altogether. It's not related to transfer pricing, but technically it belongs to the anti-avoidance mechanism. We have taken it here. 94 again avoidance of tax by certain transaction in securities. And 92A transaction with person located in NJA, notified jurisdictional area, like a Cyprus, or there was a possibility of Switzerland also to get declared as an NJA. Now these provisions are theoretical because practically we don't have any notified jurisdictional area. Notified jurisdictional area means you should remember with very basic understanding that they don't share data with government of India. So therefore they are negative country. Earlier Cyprus was the only nation which was notified. Later on they also send an apology letter to government of India. Now they are ready to cooperate. They are ready to share the data. Therefore there is technically no country as of now, to give you an example, like there is a notified jurisdictional area. So practically we don't have any country. There was a Cyprus notified, but now there is no notified country. 92B, 94B, unless and until I discuss this provision with you, you may not understand. So wait for 92B to come into play, then we will discuss. It is the limitation of interest paid on the certain cases. Whenever Indian associate enterprise pays the interest to outside India, there has to be a maximum bar. So it is a maximum bar, 30% of EBITDA is a provision. So that we will discuss when we reach to section 94B. So apart from that, whenever transfer pricing provisions are in play, you might have listened to me through the penalty chapter. We have already covered all these penalties in penalty chapter. We will again touch upon this penalty in the transfer pricing. But one thing is for sure, the penalties are in lakhs and in percentage, 2% of transaction value. Now if the penalty is 5 lakh rupees, 1 lakh rupees, I can still digest. That is payable penalty. I can definitely pay. The entities which are involved in the international transaction, they can definitely afford 5 lakh rupees penalty. But sometimes penalty is 2% of the transaction value. If your transaction value is 1000 crore, you can understand you have to pay 20 crore as a penalty because there is no maximum bar. Okay. So never ever try to default in transfer pricing provision. It is going to be very expensive for the client. Section 271 AA penalty for failure to keep and maintain the information and documentation. 271G penalty for failure in furnishing the document to the government. 271BA penalty for failure in furnishing the report, that is CA report under 92E. This is the one of the lowest penalty that you can see in transfer pricing. What is the background, sir? Can you explain us in a theoretical manner? Why do we introduce transfer pricing provision in India? Obviously, we were discussing that only. But if you want a justifiable answer, this is the question. What is the legislative objective of bringing into existence the provisions relating to transfer pricing in relation to international transaction? So let us discuss the answer. The presence of multinational enterprises in India and their ability to allocate profit in a different jurisdiction by controlling the prices in intra-group transactions prompted the government to set up the expert group to examine the issue relating to transfer pricing. Everything they have summarized in the one paragraph. There is a possibility that 2 or more entities belonging to the same multinational group can fix up their prices for goods and services and allocate profit among enterprises within the group in a such a way that there may be either no profit or negligible profit in a jurisdiction which taxes such profit and substantial profit in a jurisdiction which is a tax haven or where the tax liability is the minimum. So either no tax jurisdiction. So what they do? They are actually doing BEPS. Okay. What we are controlling here? Base erosion and profit shifting. They shift profit from India to such a nation where we are having low tax jurisdiction. And this is not only suffered by India, it is suffered by all developed nations, my dear friend. And therefore, all nations came together and they have made this law in consultation with all the countries. It's not the India who has invented transfer pricing provision. No, transfer pricing provisions are already invented by global players. We have just gone there, we have seen how it operates, and then we have adopted their transfer pricing provision in the domestic law. The way adversely affect the country's share in the due revenue. So whatever was the deserving revenue, if somebody doing business in India, obviously government of India, people of India deserve some amount of tax, but by playing with BEPS, base erosion and profit shifting, you are not paying tax in India, which was duly accrued to government of India. The increasing participation of multinational group in economic activities in India has given rise to new and complex issues emerging from the transaction entered into between 2 or more enterprises belonging to the same multinational group. The profit derived by such enterprise carrying on the business in India can be controlled by the multinational group by manipulating the prices charged and paid in the intra-group transaction, obviously related party transaction, which may lead to erosion of tax revenue in India. Therefore, transfer pricing provisions have been brought by the Finance Act 2001 with a view to provide statutory framework which can lead to computation of reasonable, fair, equitable profits and tax in India in the case of such multinational enterprise. So this was whole background. Section 92, we are finishing here itself. It's very easy section. It just gives rise to the provision. It just provides the chargeability, applicability. So section 92 subsection 1 is applicable on income or allowance for expenses or interest. 3 items: income, allowance of expense or interest from international transaction. Okay. Next one. Sir, in case of international transaction or specified domestic transaction, where 2 or more associate enterprises enter into mutual agreement or arrangement for the allocation, here it was directly income or allowances, here it is allocation. Sometimes you should understand Hindustan or Unilever is a global company and it is having multiple subsidiaries in multiple countries, India, Japan, Canada, Australia, USA, okay, and they belong to UK. So at what type of cost should be allocated by the HO to the branches, okay, so that allocation also will be controlled now through the transfer pricing provision. Allocation or apportionment of any contribution to or any cost or expenses incurred in connection with the benefit or services or facility provided by one or more such enterprises, that means associate enterprise. Section 92A talks about income, allowance of expenses, allocation of the cost or interest from the specified domestic transaction. This is for domestic law, this was for international law. And then we have to discuss the non-applicability. So from section 92, the most important aspect is the non-applicability. Whenever there is the adverse effect on the tax system of India, we will surrender the transfer pricing provision, we will ignore the transfer pricing provision, and that is written in section 92 subsection 3. Very important. Whenever there is a decrease in overall taxable income, so whenever taxable income is going down, obviously when income goes down, the tax amount will also go down. And increase in loss, obviously increase in loss, in future will decrease my tax amount. So decrease of income and increase of loss, decrease of income, increase of loss. If this is happening due to the ALP methods that we have adopted, arm's length price we have adopted, and we are changing the actual transaction price, obviously we will ignore the ALP and we will consider the actual transaction price. It is most important, or it is pertinent to note that transfer pricing provision adjustment cannot be made applicable while computing the book profit under 115 JB MAT provision. So why? Because while computing MAT, we do the specific addition and specific subtraction. We don't do any other addition. See, transfer pricing provisions are applicable to income tax act computation. That means normal income tax act computation. Here we are having allowances and disallowances. In that you can make the adjustment of transfer pricing. While computing MAT or while computing the book profit for the MAT, you should not apply TP provisions. Please mark it very important. Okay. So we will have I just give you brief idea about the transfer pricing provision. We will discuss this provision again and again in detail in each lecture that is coming on the way.